Ladies and gentlemen of the crypto space, we're live on a Monday, December 19th at 11:03 a.m. A little early today. I have a couple things to do in the afternoon, but I wanted to talk about a topic that helps us understand why things are occurring, why things have occurred, and the best way to understand what's going on is history. The best way to understand is looking at traditional financial markets to start to understand what the hell the United States did that made it so successful. Now, obviously, the vast majority of people don't necessarily know the nuances, but my capacity is to see the relationship, to see the analogies. And I would imagine a lot of these analogies have been seen in the early implementations of DeFi protocols, especially the iterative implementations that are starting to be developed and deployed because they saw the successes that have occurred in the initial stages of the DeFi space. And all in all, it also really all started with the United States. And the United States, obviously, they call it the global reserve. It's the centerpiece of financial activity. You know, it's 60 something, 70% of financial transactions are denominated in dollars. Well, how do you do that? Why is that the case? And that's interesting. So, I'm not the greatest historian, but suffice it to say, it was the oil deal with Saudi Arabia and pricing of commodities in dollars. And that changes everything because now, if you're in any country around the world and you want to buy oil, you need to first purchase dollars. First off, that is a very important thing to understand financial markets is to get your head around what the hell a currency is, what is Forex, and the concept of purchasing dollars. Now, if you live your life in a financial market, you don't really think about these things. But if you start to reorient the way you think, considering that reality of the rest of the world, you start to really, at least the most important thing to understand the way these systems work. Purchase dollars. You're purchasing a currency. You have to purchase a currency before you can purchase oil, and that changed everything. Why? What does that do for the bid of the dollar, the demand for the dollar? If your country needs oil, you first got to buy dollars. All of a sudden, there's a tremendous amount of demand for dollars just to purchase the commodity that you're looking for. So that changed everything. And it gets more complicated because now the world is dependent on U.S. bonds. That was an organic manifestation in many regards. Now, obviously, because you have a commodity priced in dollars, you want to engage in financial activities that are going to allow you to acquire more dollars, and the easiest way to do that is in a dollar denominated fashion. So you borrow dollars, you leverage the collateral, the sovereign debt, and you do these derivatives, and then you get more dollars so you can buy the commodities. It really all reduces to commodities, as the vast majority of traditional finance talks about natural resources, so on and so forth. But we've entered a digital world. We've entered a world where there's so many people, and this plays into a narrative that I talk about of it's not a labor force crisis. We have a crisis of underemployment. So what do people do? So, a lot of people argue that the financialization of the world is not necessarily a good thing, but in many regards, I think it's a requirement. I think there's no way there's enough just traditional labor, commodities, manufacturing, uh, assembly lines. There's not enough labor to keep the world employed, and it's not just employed for purposes of productivity. It's for purposes of social order, maintaining civility. You need activities for these people. So you're not going to be able to do that just producing and just contributing to traditional commodities based GDP. You need something new. And that's really the type of world we're heading into. So that gives a lot of room for new analogies, new, not artificial, but synthetic constructs. And these synthetic constructs, the best place to look for how to structure them to be successful is history. It's always history. So the United States forced commodities to be priced in dollars, which cascaded into all this financial activity involving dollars. And then obviously, they started issuing a shitload of debt. And the world was like, oh, what are we going to do with these instruments, these securities? Oh, let's use them as leverage. Why? Because they're priced in dollars. They'll allow us to get more dollars so we can buy the commodities we're looking for. So we're not going to digress into the complexity of supply chain and inflation, CPI, so on and so forth. That's another story. But what fascinates me the most is the concept of pricing a commodity in a currency unit, and then the organic manifestation of external actors saying, hey, I'm going to adopt this and be like, oh shit, I want to accumulate this currency unit because it allows me to purchase a commodity, or in this instance, a synthetic commodity. And you have the same paradigm. And all of a sudden you got leverage, you got derivatives based on this currency unit, and it's not just one currency unit. I'm not going to highlight just curve because it's the concept, and what we're starting to see is protocols uh, observing what organically emerged, and they're like, oh shit. And it's this story that I'm telling you. Why do you think Aura and Balancer is doing what it's doing? Why do you think the price action is doing what it's doing? Why do you think external protocols are accumulating? They're accumulating because of what we've talked about. Everyone knows you need a capital efficient way to finance liquidity, and that plays into the commodity that is offered by these pieces of software. And there's only a few protocols, newer protocols, that are building new implementations that have really identified this sequence of events, identified this phenomena for having occurred, and they're iterating and making it new and taking it to the next level and making it more sophisticated. And that's cool. That's interesting. That's probably the biggest innovation of the entire crypto space. So people, over the weekend, and every time I get to talk to family, and every time I get to talk to outsiders, they barely understand the way the traditional financial system works. If I told them, I blow people's minds when I say purchase dollars. It's like, whoa, what the heck? How many dollars did you purchase? And then it's the flipping of the script thing I talk about. And we're way beyond that. The stories that we talk about are not just understanding the traditional financial system, which I'm trying to introduce in this stream, but it's understanding these things that we've started to and quite understand about traditional finance. It helps us understand the way these software protocols are working. Now, I do think, was it blockchain that made this stuff happen? Or obviously, literally all of this can be done with software and centralized implementations. But I guess that would digress into the narrative of non-custodial and decentralized infrastructure where you could actually own something. So I think that's a quick summation of that angle of this story. Um, but back on track, what's the commodity? The commodity is, interestingly, inflation. And the commodity is the capacity to offer a capital efficient financing of liquidity incentives. Now, clearly, this is all financialization. But what did I say earlier in the stream? The world desperately needs financialization to accommodate the lack of the world maintaining civility and order just using traditional or very expected labor activities, mining, manufacturing. There's just too many damn people. You're not going to have 8 billion people being farmers. Or the assembly lines are done. That's robotics. And look where the world's heading with robotics and the disruption of fast food and restaurants and vending and managing retail stores. I mean, come on, in 10 years, you think any human being is going to be stocking the shelves of Walmart? So we're on the verge of a crisis of labor, And we're going to need a massive, massive amount of activity to keep and maintain social order. So that will require further financialization. So, maybe a part of where we are in the equities markets and Wall Street is perverted financialization. And financialization, comes off as a dirty word. It's talked about with negative overtones. But, it's very important to peer through the madness as we talk about. What if it's not necessarily dirty? What if it's not necessarily perverted? What if it plays into a larger narrative of shit that the world desperately needs to maintain social order and actually keep people busy? How do you finance social order? Now, clearly, anyone could do this stuff. Sovereigns could do this, and that's what they did in 2020. They financed social order. That's what they did. I don't. You could say whatever words people think best describe what they did, but that's what they did. They brought in capital, so people did not go in the streets and start doing crazy shit, uncivil stuff. So, you know, we get a sense that's what occurred. So we're looking to history. That's what occurred literally just 2 years ago in 2020. And that's what we're doing in the crypto markets. That's what we're going to need to do in traditional finance again, finance social order. And conveniently, it looks like the crypto markets is doing something interesting around this concept of how do you keep people organized and civil in a world where not everyone can be farmers and work on an assembly line. Let's pop it over to the main screen. I'll probably just put up a chart and I'll continue with this thread. So we look at what I call the source of truth in the crypto markets. It's the premier commodity. It's Curve. And Aura and Balance is doing interesting stuff. And Tapioca, their documentation is very interesting. And I mentioned IPOR recently. And anyone that wants to build something that has traction, something that has shown to be meaningfully based on the historic precedents of what really makes a financial system work, needs to look at this stuff. They need to iterate and base future implementations on these types of analogies and these frameworks that have empirical evidence suggesting there's something meaningful here because it's based on history. So the commodity is inflation. The function, the interest is the capital efficient financing of liquidity. Why do you need liquidity? Maybe an entire story unto itself, but if you want to launch a protocol, if you want to maintain a peg of a stablecoin, you need liquidity, you need a capacity to finance it, and you want to do it in a capital efficient way. So why do you place this asset in reserves? Because it facilitates governance and a capacity to direct this liquidity. So imagine the Fed, where you could buy sovereign bonds, maybe a new issuance of bonds, and allows you to vote where a credit facility is instantiated, or allows, like, maybe even fiscal policy, buy some sort of new instrument and allows you to vote where some sort of subsidy or tax incentive is directed. That's what this is. Apply DAOs and voting and all of this to the traditional world. Congress, they're voting for fiscal policy. The Fed, they're voting for monetary policy. And draw the analogy, and you're like, oh shit, that's crazy. Um, so these assets, Aura, Bow, you see the drama. Why is Humpty, why did he do what he did? Because maybe he sees this analogy and maybe he's able to mentally do that thought experiment of rolling the clock forward 5 and 10 years. And maybe he sees these types of things, and that's why he deployed so much. And why are new protocols? Why is IPOR looking at Curve? Why? Why would someone look at another protocol and be like, oh, and why did Andre do what he did with Solidly? And why is Velodrome doing those activities? Why are they ex, expending effort because they saw something, they saw opportunity, and they're drawing reference, and they're trying to say, oh, look what worked. We're going to do this, tweak this, iterate on this, enhance this, make this better, and do something new and interesting that other people will be interested in. They'll participate. Well, that's quite fascinating. So these assets that direct inflation are placed in reserve. Why? Because that gives each protocol a capacity to, in a capital efficient way, incentivize the liquidity of their needs. They for survival, these protocols that have chosen organically to opt into these systems, um, they've chosen to accumulate these assets for purposes of survival to facilitate their own needs. So all of a sudden, every single protocol that has done what we see is being done with the curve wars and all these protocols accumulating convex and what Tetrano talks about with redacted. If anyone sees this, it's him. Um, they place it in reserves, and now they have a vested interest. They have a vested interest in maintaining the survival of the very thing they're dependent on. So for better or for worse, this is the case with the US dollar as well. Now, obviously, the biggest overtone in the crypto markets is animosity towards US financials and animosity towards the dollar, and I call bullshit and all of that. The only animosity anyone really should have is the human component of monetary policy. And maybe, the human component of the perverted nature maybe of congressional fiscal policy. It's the subjective allocation of funds, so on and so forth. But it's not the system. The system worked. So I urge everyone to peer through the bullshit of traditional finance and see what the system is, how it works, why it works, and the fact that every single country around the world has a vested interest in maintaining the function, the normal operating procedure of the United States financial markets, because they're all dependent on it. It'll be another 20 years before something breaks, well, I don't want to put timelines. Anything could break at any time, but I mean, they're all actively. You can't have the bond market collapse, and they all know it. They all know it, and there's a reason why they still have all the reserves they have, and they're not dumping hand over fist because it's not going anywhere. They all have a vested interest in it, and there'll be a complete collapse into anarchy and chaos without a functioning global financial market based on the dollar. So that's what's starting to emerge here. What happens if curve price goes down too much? What happens? It's not going to be good for any of the protocols involved. They won't have a capital efficient way to finance liquidity, and all of a sudden the mark to market on their balance sheet is not in a good position. All of a sudden the valuations have dropped significantly. So their collateralization, any financial activity they do with assets on their balance sheet, maybe they get liquidated, maybe they have to deleverage, so on and so forth, and their income from their financial activities is impeded. So the same thing is occurring for very similar reasons in a very comparable implementation for very comparable purposes, yet different purposes, and the different purposes is what I talk about with regard to the future um, labor crisis of underemployment. Anyway, so that was an interesting story. Every time I tell the story, it gets clearer and better. We talk about this a lot because, what really occurred in the last 2 years? Well, what is unique and special and different, and the general public doesn't see it. Maybe I get excited to talk about this topic every time I talk to friends and family, and they're like, "Oh, everything has crashed, FTX and Dogecoin and the price of things, and who gives a fuck about the price of stupid shit? Who cares? I know many of you maybe had exposure to FTX, but anyone that really listened to the stream and took things to the extreme that I did had zero exposure to FTX, zero exposure to centralization, and we have our capital in decentralized control where we own our assets, and we've exercised to the full extent our capacity to protect our ownership of something that is talked about as outside the system. That's crazy, outside the system. I get fired up when I talk to friends and family because I see the shit that other people don't see. Rewind to the beginning of the stream, and that's the stuff that they don't see. That's the stuff that the majority don't see. It's not that they don't care about it, it's that they haven't spent the last 2, 3 years trying to digest what the hell is going on here. And maybe it's really big. And maybe even traditional finances is unfortunately intimidating. That's unfortunate. But ultimately, that's why we do the stream. I know this is complicated dialogue, complicated talks, but this is real. Everything we talk about is real. It's not like it's not occurring. I don't care how much a detractor or a hater of crypto, where they say it's all going to zero. I don't. It's irrelevant because what I say is rational. Therefore, it's based on empirical data. This has occurred. This is occurring. This is speculated to occur. This is based on precedents. We're drawing on historic analogy. There's a comparison between what occurred in traditional finance to what is occurring here. That's not. It's debatable, but it's not dismissible. There's not a damn thing we talk about that is dismissible in entirety. James, good morning. Been a while. A pleasure. Dan's in the house. Daniel, a pleasure. Very relatable point. Most people don't understand anything in regard to money. I've begun to dig deeper into the history of banks, and it's blowing my mind. It's as if it's a story out of a movie. Sure, it's quite startling. And what you realize, it's a manifestation, it's a creation, it's a construct, and all this logic and planning has gone into the execution and strategy and geopolitics. And I mean, look, the linchpin of where we are with the United States is the pricing of oil in dollars. That started everything, and you have that with this very asset that we're looking at, this very protocol. It's the pricing of inflation in a currency unit. So the analogy is there, and it's quite mind-blowing. Tapsy, hello. Daniel, ZDM, my man. Dan, how was the percent of curve lock change recently, if at all? It's not. It's trending in a decent direction. It's not like, oh wow, that's incredible. But there's an upward slope to locking. It's stable. It's not like there's a spread that's occurring. It's not like they're deviating or divergent. So, if anything, it's stable. And I would say that this chart speaks volumes. And I would say we had a systemic instability here. And that's what manifests. But the fact that the trends are directionally intact is supportive of continuation. Why would they all of a sudden spontaneously become divergent? What would invalidate everything that has occurred? So it doesn't make any sense for invalidation. It makes sense for things to continue, and these narratives did occur, and they're just going to continue to play out. Squalor, good morning. I'm interested in redacted as well. Interested in it, but bear in mind that's like Eurozone. That's like Great Britain accumulating dollars in reserve. So it's an interesting comparison if you think about it. It's an actor that's participating for their own interest in accumulating these currency units in reserve. So he's very smart. There's a reason why he got to where he is, Tetranode. And it's a heck of a protocol. I have no interest in it. That's like looking at France and their balance sheet, or pick a sovereign, and they're accumulating assets in reserve for purposes of their own financial interest, for purposes of leverage and creating cash flow and creating power. So when a country has ample reserves, they have power to exert influence. That's what he's doing. Compare this shit to sovereign nations. Why not? Makes sense. Gazika, hey Noah, what's up? Do you think Velodrome, New Curve, unsustainable Ponzi? Well, solidly. Uh, and I don't like the word Ponzi. In fact, uh, there's been no Ponzi schemes in crypto, and I say that taking pause and being specific what I say. What there's been is failed currencies that are hyperinflationary that have no understanding of how to balance a balance sheet for the enterprise analogy. And they've just destroyed the value of their currency by creating too much issuance, having too much in circulation. They ramp their M0 to infinity and beyond. So what you have is failed monetary experiments, failed financial experiments. A Ponzi scheme is where you take investment income and give it back to people to pay their interest, their returns, which draws in more people, and you use that money to pay for more people. I don't think they're. I mean, FTX had components of that Ponzi. That now that we see what their behavior was, but a lot, even some of the worst crypto protocols wasn't certainly directly a Ponzi. So I'm obviously digressing because, what's so important is to not just throw around words randomly and blindly. So Velodrome is solidly. And solidly is what Andre conceived in his documentation. And that was one heck of a monetary policy. So Velodrome fixed the V1 implementation, which didn't really interest me much. It was a massive failure. But solidly on mainnet is a V2 implementation, which they went over everything. And the whole point is they want to manifest what Andre talked about. What Andre talked about was brilliant. His ideas and his capacity to see these systems is brilliant. His implementations have been historic failures. Separate and apart doesn't mean anything. That means if you get the implementation right, oh, you got a brilliant protocol. That's what that means. So uh, that's the deal. That hope that helps. George, hey Noah, how concerned are you about this Warren bill? Sorry, you already addressed this. Just signed on. Anything that happens in Congress is going to take a long time. There's a lot of people in Congress that see the potential for these synthetic financial constructs. And maybe they see it the way I'm describing it, as an eventual need to finance social order and stability. And I think government is limited in that capacity. Uh, historically, you can't just pay people not to do anything. You, you need you need at least the illusion of productivity, and that's what play to earn and gaming and participating in digital DAOs and there's so many ways I can imagine from a digital perspective to be productive or create synthetic productivity, not dealing with commodities, but dealing with the creation of systems and art and curation and contributing to artificial intelligence and aggregating data. There's so many activities, so many things that can create uh, not traditional not traditionally what productivity is defined as, but a form of digital productivity. So I'm not too worried. Why? First off, it can affect price, but it can't affect any of the systems we talk about. If you haven't noticed, Aura has spent a fair amount of time hidden their IPFS implementation. So the contracts are deployed, and you could always be critical of the immutability of contract deployments. But look, now their user interface is deployed in IPNS. So you can access this no matter what. They would have to block at the internet service provider level to prevent access to this. This is not going to a web server. This is not going through a domain that's hosted on GoDaddy. This is going directly to a distributed network of services that uh, offer access to this user interface. So that's quite interesting. We're seeing protocols deploy in IPFS. Warden's on IPFS. 1inch is on IPFS. Curve is on one IPFS in one form or another. I've been looking into Pinata and potentially being downloading these user interface and deploying them on IPFS. Probably for myself. I don't want to make a publicly accessible implementation. But this is very interesting. Making sure that no matter the regulation, you still have access to these systems that generate cash flow because if the U.S. does regulation, there's a fucking big world. The U.S. is kind of small. It's meaningful from a financial perspective, but there's a lot of people around the world. And you think anything slowing down in India? We got all those people that you see that are head over heels with Polygon and all that activity. You got a country filled with young kids that are very, very tech centric. The India narrative that we talked about in late 2020, 2021. That narrative is definitely still in play big time. Um, so no, I'm not worried about it at all, George. Dan, do you compare percent of curve locked versus aura to determine which purchase more of? Well, I'm not really purchasing anything right now. I am saving. I was talking to my uncle the other night, and most people think during good times you save for bad times. And that's the saver mentality. But what has this world become? It's the antithesis in many regards. And the contrarian in me says, when times are good, spend money. When times are bad, you still should have enterprise. You still should have business. You still have cash flow. You still have employment. That's when you save. You save when times are bad, so that you have working capital for when times are good. Because working capital when times are good is when you could make your multiples. You can make a 10x and turn everything you saved during shitty times into nice money, which you could spend, and we could discuss again financial management and our activities when times are good again. I look forward to times being good again. But now we're starting to digest the transition from what was good over the last couple of years to now a period of financial repression and austerity. And this is kind of the way I'm thinking. During times are bad, we're saving. So I'm not deploying. I'm saving, and I have cash, and I have to. It's December 19th, so I gotta open up the QuickBooks, and I'm gonna have to dump my QuickBooks and do my personal accounting, my business accounting, and I want to make sure that I have enough stored cash, either in bank account deposits or in stable coins. And you know the deal. Stablecoins are very spendable nowadays with debit cards. And QuickBooks does a wonderful job in managing a balance sheet, income versus expenses. And that's this has been a very eye-opening, interesting year. Uh, New keeper plans. I haven't seen the new keeper plans, but obviously the beauty of a locked position is they're going to do what they're going to do, and I don't, I may have a governance say in it, but it's going to be there. And if anyone deploys immutably, that's Andre. So I like the fact that it started paying out stables again. I look forward to some keeper options. I did see stables. I saw like $250 in IB your EUR. Where's my stables? Oh, anyway. But you guys said you saw it as well, the stables. So I look forward to getting a little bit of cash from this protocol again. Let's go back to the chart. Let's look at this while we talk. Um, Adam, here late, but good to see you, Noah. AI related wondering, since it's computationally expensive to generate new models, would it be technically feasible to distribute the GPU? Well, yes. Well, well, of course. And you crowdsource, and you're able to get you could build implementations of nodes that have associated with compute. What do you think RenVMs were? And that's what had me excited from day one. It was basically a network of virtual machines. And they even put VM in the name, where they were able to coordinate and control and deploy to this network to facilitate the function of the protocol. So yeah, absolutely, you're able to distribute the compute needed to do these very powerful things that even supercomputers, you could probably outperform supercomputers with enough decentralized compute power. In respect to Chat GPT and those kinds of models. Now, bear in mind, to get a network of decentralized compute, you need incentives, you need financing. So this is it's a complicated problem. There's a product, there's a use case, and it's in need of a solution to effectively incentivize participation. So very interesting. Good point. Good morning, sir. How are you? I'm good. One curious. I'm gonna step out of the house in a little bit. I took care of a couple of pull requests and change sets for the code base I'm working on, and that's about it. It's Monday. It should be a quiet week. We're heading into the new year. I feel good. I've been doing some cardio lately, so I feel pretty good. Thank you for asking. Um, Lose my job. If anyone's employable, my friend, it's me. My industry, Android software development, the last 14 years has been, there's never not been work. So I thank you for inquiring. No, everything's very, very good. Appreciate it. Adam, are there any AI related crypto projects that interest you? Hard to determine what seems legit and which are just playing off the narrative without utility. Not really. Um, Not really. There's a bunch of, if you're talking crypto, it's the decentralized compute protocols, whether they're using a UTXO blockchain, because there's still plenty of protocols that are still developing UTXO implementations. Siacoin still has traction because that's decentralized file storage. And Filecoin obviously got hammered because they just took on too much VC capital and just got exposed way too much to collateral explosion. But Filecoin, Siacoin, interesting stuff. And what is a handshake protocol with Beacon, the Shake XYZ. Very interesting. Oh, I don't even have it on the screen. Here, the Shake. So what is that? Handshake, HNS, which is an entire blockchain. It's a UTXO chain, so that's very interesting. That's decentralized. It's like IPFS. It's the new internet of sorts, and that's where we're heading. Is direct P2P communication, file storage, so on and so forth. How do you store a website on 10,000 computers while none of the computers know what they're hosting, but everyone has access to the website? And that's what IPFS and other types of protocols like this, HNS, are attempting to solve. Um, Caleb, what do you make of the long-term demographic trend related to global GDP? How can we see risk of assets like crypto decoupling from TradFi? Yeah, I starting to see inklings of decoupling, but I'm not going to talk about it. But I had a feeling the other day, and I had a sequence of events in my mind, and that was tantalizing. But there's just so much potential for volatility, and I still see the correlation, risk and fear. I mean, come on, that's not going to decouple if you got everyone freaking afraid. But that was what I was thinking. It was the downside decoupling. I mean, come on, if you have, look at all the contagion we had in the crypto markets. You didn't have that kind of contagion in equities markets. So I got a sense that you can see downside decoupling, not upside. But if you have contagion in traditional finance, I mean, the question becomes what percent of those traditional finance actors have exposure to crypto? I mean, it's such a small amount of capital in crypto. You're talking about, over 620 something trillion dollars in OTC derivatives and all this bank leverage and all this capital. There's nothing in crypto. So what's the exposure? If you have contagion there and you already had all this contagion in the crypto markets, it'd be very interesting if you had a massive contagion in traditional finance and the crypto markets went down 10, 20%, And the much talked about 50% decline in an S&P, like a real contagion event, that would be interesting to see the decoupling on the downside. But there's no upside until you have liquidity. The entire system is dependent on liquidity. That's why, I've done the threads on social media I've done. That's why we look at this chart. That's why we look at DeFi Llama. That's why we look at the dollar, because this gives us the perspective on liquidity. And right now, liquidity is stable. Go figure. Everyone's screaming the down, it's going to go down. But the liquidity is stable. If anything, the liquidity is up. The domestic liquidity has gone up 7.59% in the last 2 months. And the dollar's stable. So, rest of world liquidity is relatively stable right now. And if the dollar goes up, that sucks liquidity out of the system, because that means it's more expensive to buy dollars to service debt. So there's less free liquidity available. So basically, if you're looking at dollar, and DXY is decent, it shows you basically the euro and Japan, you're talking about rest of world systemic liquidity. And this is obviously crypto central liquidity, which is still deflating, deflationary liquidity. It'd be nice to see this go up. Anyway, demographics. Well, right now, Peter Zeihan talks about how China is doomed with regard to demographics. But that's a very long-term trend. If you're talking about like population demographics, 10, 20, 30 years are easy topics of conversation. And the trend is down. So the trend is towards deflation everywhere. Population decline. I guess education might be decent. You know what's so interesting is the credit scores in the U.S. with regard to the housing market. I found that quite interesting. So really, everywhere I look, folks are looking for like big risk off, long end duration treasuries going risk off mode, but I don't see the systemic fragility. The credit scores on the mortgages and the equity in real estate in the U.S. is nothing like 2008. 2008 conditions don't exist right now. They just don't exist with regard to real estate, and that's quite interesting. Now you might have a complete collapse of sales and price, but you don't have a contagion with regard to mortgages blowing up. So that type of systemic risk doesn't exist. But you have all the hits to GDP that could occur, and the contraction of financial activity, which is literally what they want. They want the contraction of financial activity because they could control that with interest rates and fiscal spending and whatever else they could do from a monetary policy standpoint. Because obviously fiscal, we know what it could do. We saw that shit get tried and tested in 2020. But I posted some tweets this morning where so many facilities are designed to mute volatility, and that's really what we see. Two more charts. I'm going to have to wrap this up in a couple minutes. Everyone's like, why is the VIX so low? Why is the S&P? Why is it not just crashing? Because volatility is low. And why is volatility low? I mean, what you have is bearishness. What you have is depreciation. This isn't volatility. This is, all right, people are selling. It's not like, it's not like a crash. And if you go over to the VIX, I bet you the VIX is, up a little bit today, maybe a little muted. It's not like it's 5,000. Let's go out to the monthly. Oh, it's up a little bit. It's got a heck of a candle, but it's not like it's screaming in 2020 up to 84. It's 21. Yeah, it was depreciation in the S&P. Why? Because they have all these damn facilities, these Fed facilities designed to mute volatility. Let's look at bond market volatility. Bond market volatility, I found support on the TWAP, whatever that means from a volatility standpoint, a moving average, but it's there, which is interesting. So volatility is muted. It's down off the highs. And it didn't exceed March of 2020. But look, we just had a crisis in bond market volatility in October of 2022. So this is a crisis of bond market volatility that we just got through and we pulled back. Whether we see more pronounced volatility in the bond market, we'll see. But look, it's down. So everything we see across the board is volatility retracing. Relatively, of course. Hope that helps. And what do you need for capital deployment? So bear in mind, you can have deflationary global currency, you can have impeded GDP and productivity, you can have job losses, but if you don't have the volatility and a giant spike in job losses, a giant spike in volatility in equities markets and collapses and crashes and collateral exploding and liquidations, you have relative calm. And as long as it's uh, an orderly decline, it's an orderly bear market, you're going to have capital deployment. Just because there's a tremendous amount of deflation in the system doesn't mean there's not a historic amount of liquidity and capital. It's just going to force more well thought out deployment, more well thought out allocation. Very interesting. Killis, good morning. One curious, yes, folding, yes, that's a great example. Most of these things I know of, I just clearly didn't come to my mind, but that's a perfect example of distributed supercomputer level project. Well known, that's historic. That's going back a decade, I believe. Uh, Appreciated Squalor, 29 people in the stream, 13 likes. We can do better. Critical Mass Jim, you're saying this is the bottom? Well, yes, this is the bottom until it's not. This is the bottom until you have a volatility spike. So with barring liquidity, like artificial liquidity injection, and just like artificial volatility suppression, because everyone's just buying, they got free cash, you have the potential for volatility. But right now you have volatility suppression going on, and look at all these Fed acronyms. That's volatility suppression, and it's literally designed to prevent the collapse of short end yields. The reverse repo can prevent um, all of us. They could force the banks to purchase bonds, and purchasing of bonds drive down yields. So they could control. They have a capacity to control the curve, not the curve, but the yields on the short end, short duration. There's facilities all over the place. It's quite fascinating to think about, the aftermath of 2020 and what are the increase in derivatives. Look at this. So, who's the smartest actor in the room? I mean, the smartest actor is not necessarily the best place to look, but OTC's derivatives went risk on in Q1 2022. I was waiting for this for a while, and I was waiting to see whether they go risk off or risk on, and they bumped it up 7% or was it? I posted it earlier on Twitter. $632 trillion. So this, Brent Johnson said very clearly, this is fine. There's nothing wrong with this amount of leverage. The problem is volatility and counterparties exploding, and then all of a sudden you can't sell if you wanted to sell. So, notional, it's a big number, and it basically balances barring volatility. So who knows this shit? The Fed knows this shit. They know that the banks know that the Fed knows this. Everyone knows everything. It's the way it is. So they just went risk on. The banks just went risk on. Global banks, J.P. Morgan, all of them, Goldman, risk on because of the Fed doing all their acronym facilities to suppress volatility. And that's exactly what we see in stuff like the S&P, which is a microscopic market on the global scale of derivatives and currency and so on and so forth, and euro-dollar markets, so on and so forth. Come on, this is not, look, it broke through a massive support, and it's not just collapsing. And obviously after the stream it collapses, and I'm like, what the hell? But this is orderly. It's orderly activity. On the monthly, this is a big decline in June, but if we go to the weekly, it's relatively orderly, albeit this is a massive, massive bear flag. James, a pleasure. Hope everything's well. Monday, December 19th, 11:51 a.m. As always, I thank everyone for joining me. Tell everyone to subscribe because if they don't listen, I can't help anyone, and I would like to help more people. After party on Discord for the most rational community in the entire crypto space. I appreciate everyone in there. Love the talks, and we do better together. Have a good week. I will see you guys at the end of the week. Peace.